Nouriel, you said we are potentially looking at the worst recession in 40 years, you believe. I want to ask you, fundamentally, how does our economy recover? What's the underlying strength that will help the U.S. economy weather what sounds to be a really terrible storm ahead?
That's a very good question, because for the last 20, 30 years, the economy has been growing very fast only when we had asset bubbles. It was in the 80s, and we had the real estate bubble, we had the bust with SNL, then we had the internet bubble, and then we had the recession in 2001. Then we created the housing bubble, and we're running out of bubbles to create. We'll have to think about a fundamental change in our economic priorities. We've invested too much into the stock of housing capital is not productive, not enough into machinery, software, and other things. We have invested too much human capital into the financial system, too many financial engineers, not enough computer engineers or mechanical engineers. So both the human and physical capital of the country has to go in the things of the future, alternative energy, green technologies. This might be probably the new wave for the United States.
Is it going to be difficult for us with a manufacturing base that's not as strong as it was decades ago?
Absolutely. Our manufacturing base has been significantly impaired. Of course, with a weaker dollar, there may be a recovery of manufacturing going on. But there has to be a radical shift of economic policy in the direction of investing to the right types of capital and the right types of skills and education in order to increase productivity growth, given also the demographic trend that's going to imply significant fiscal problem in terms of entitlement spending. So the new president, whoever is going to be, is going to have a radical, difficult problem. First, you have to clean up the economy. You have to reduce the financial crisis. You have to get us out of this recession, and then think about the long term.
Let me ask you, too, since we're going back a couple of decades, we'll go back to the 70s when we had a very tough economic situation. What about inflation?
I don't worry about inflation, at least in the short run. We're going to have a slack in goods market, with demand falling. That's going to reduce inflation and pricing power of the firm. We're having a slack in labor market with rising unemployment rate, and now we have a sharp fall in commodity prices. So in my view, inflation is going to be the least of the problem that the Fed will have to worry about. Significant recession and significant financial risk are going to be the fundamental risks that the economy is facing from now on. 6 months from now, we might be worrying about deflation rather than inflation, because it's going to be a severe U.S. and global recession.
Potentially, how high could the unemployment rate go?
I expect unemployment rate to be as high as 9% at the peak of this crisis. It is much more than previous recession. The last two recessions were only 8 months each. This one is going to be at least 18 months, possibly 24 months. It's going to be much more deep and protracted than the other ones. A lot of damage has been done to the financial markets, to the real economy. The economy was already contracting sharply in July and August before these financial shocks of the last few weeks. And these financial shocks are going to make the credit crunch more severe. There is no credit provided to the private sector, to the household sector, and therefore the economy is going to have a severe recession unless we have a major fiscal stimulus coming up.
Nouriel, I want to go back a little bit. When Treasury Secretary Paulson first proposed the bailout, of course, there was a lot of protest. A lot of members of Congress heard from their constituents. People couldn't fully make the connection. Let's make the connection. Let's talk about homeowners and other people who have mountains of debt that are trying to figure out how they're going to work their way through what you say will be the worst recession in 40 years. What has to be done to turn housing around? Should some of these people be helped directly by the government?
Yeah, what's happening right now is that there is a debt overhang in the household sector. Credit cards, auto loans, mortgages. There's a good fraction of the household sector is insolvent, and that's why they stop spending and now consumption is falling sharply. You know, when a country is bankrupt, like Russia, Argentina, they default, they reduce the face value of the debt and they grow again. When a firm has too much debt, you go in Chapter 11, you reduce the debt level, you grow again. Same thing for the household sector. You need to do what was done in the Great Depression. There was this homeowners loan corporation that bought all these mortgages from the banks, reduced the face value, converted them into long-term fixed rates, and you avoided this tsunami of foreclosure. We need to do something similar. We're already doing something was done in the Great Depression. We created the RFC that recapitalized the banks, 4,000 of them. We're doing the recapitalization of the banks, but the bad assets of the banks are the heavy debt of the household sector. Until we reduce this face value of the debt across the board, and the faster you do it, you're not going to have a resolution of the problem of the household sector, of this debt. There's a drag on the economy and consumption. So that has to be part of the resolution of this crisis as well.
And that's better than letting some individuals file for bankruptcy or watch more homes go into foreclosure.
If you have more and more homes going to foreclosures, everybody's losing because the creditor has all the liquidation costs, the borrower is losing the homes, and the government eventually have to bail out. The banks are going to be having greater losses. So you need to do something like an orderly restructuring. It's going to be beneficial for the borrower, for the lender, and also for the government. That's why you need across-the-board debt reduction, significant ones, 20, 30%. There are about 40% of households that at the end of this crisis are going to be into negative equity, meaning they have a value of their homes below the value of their mortgages. And since mortgages are non-recourse loans, there's a huge incentive to walk away from your homes. And this tsunami of foreclosure is going to depress further home prices, because even today, about a third of all existing home sales are either foreclosed homes or short sales, and that's putting further downward pressure on home prices. You have to stop this foreclosure, otherwise it's going to be a bigger disaster. And housing is not bottoming out. Home prices already fallen 25% from the peak. In the 1991 recession, it was only 5%. They're going to fall for sure another 15%. The cumulative fall in home prices before they bottom out in 2010 is going to be 40%, even worse than the Great Depression. This is a
40%.
40%. Given the excess supply today, given the relative price to rental ratio, given the index of affordability, they've already fallen 25%. They'll have to fall at least another 15% before they bottom out. So this is going to be the worst housing recession we've had since the Great Depression. It didn't bottom out a year ago. It's not bottom out today. It's getting worse. It's not getting any better. Home prices are falling. Home sales are falling. Production of new homes is falling. There is no bottom to it. And,
listening to you, it sounds like awfully scary times.
It is a scary time, and as I said, it's not just housing. The excesses of this asset bubble and credit bubble were widespread. Was commercial real estate, was residential, was consumer credit, was muni bonds, was corporate bonds, was all over the economy, a huge debt bubble and a huge credit bubble that now is deleveraging, having massive effects negatively on the stock market and on the financial system. It's going to be very, very expensive. I estimated 6 months ago that the credit losses will be at least $1 trillion, as high as $2 trillion. Now even the IMF and other private institutions are estimating these credit losses to be at least $1.4 trillion and as high as $1.6 trillion. So my estimate of $1 trillion right now is not a ceiling, it's just a floor. We're going to end up having credit losses closer to $3 trillion. That means that $250 billion to recapitalize the bank is not going to be enough. We'll have to do much more, the government and the private sector. Otherwise, we're going to have a systemic banking crisis.
You mentioned in the first half of the show there would be new regulation that comes out of this. What sort of regulation would be best, do you think, for these markets and the financial system going forward? And how will that address an idea we haven't talked about lately, and that's moral hazard?
Well, in the last 8 years, the ideology in Washington has been of relying on self-regulation. That means no regulation, on market discipline, but there was a failure of market discipline, on internal risk management models. But, when the music is playing, you got to dance, as Chuck Prince said, and therefore the internal risk managers are ignored, and reliance on rating agencies that had major conflicts of interest being paid by those who were supposed to be rating. So I think we have to change radically the way we think about the regulation and supervision of financial institutions. We have to broaden it beyond just banks and investment banks towards also hedge funds, directly, indirectly. And we have to make sure that actually we rely more on rules and less on principles, because the reliance just on principle has not worked. We don't want to swing all the way in the other direction, but certainly we need more rules and better rules.
Nouriel Roubini, it's been a pleasure having you on Open Exchange. Thanks for being with us.
Hear more Bloomberg News reports on the Bloomberg Terminal at AV Go, on Bloomberg Television, and on Bloomberg Radio. Copyright Bloomberg LP 2008.